I'll take you through to the process of thought process of options and the risks involved, the mistakes that are made by people during trading options. Now, what is low risk and what is high risk? Low risk is something you buy at the money call and put options. As the example I had given earlier, buying that was an at the money call option that you had bought. If you would have bought it out of the money, say that stock price is trading at 100 and you're buying the 110 strike call option which is trading at 1. Generally what you'll feel is that 110 strike call is cheaper because it is trading at 1 while the 100 strike call was trading at 5. But in actual case, it is actually not very cheap. It is in fact expensive. If you look at the calls and the puts, you're trading for that at the money call strike of 100. Both the call and the put would be priced at 5 each. If you bought those both, that would mean you're paying 10 rupees upfront. That is 10% on that stock price. Now, if you only have to buy one of them, say the call, I would suggest buying that 100 rupees call strike if your direction is that you feel that the market is going to go up. That would mean if even at 1 rupee gain of that particular stock, you would stand to gain 50 paise on that particular call. But that 110 call strike that you've bought at 1 rupees, even at 1 rupee increase in value of that particular stock, only 10 paise is to gain. Also, one thing to note here is your call strike of 110 is deeply out of the money. That means there has to be a 10% rise from the particular stock from the current levels only to break even to your strike, and then another 1 rupee for you to actually be at cost. Then from there on, if it rises another 1 or 2%, you stand to make a profit. That means the stock will have to give you at least a 13-14% rise from the current price only to make a gain. And generally on an average, a stock does not rise 13 to 14% in a month. On an average, it is only about 7 to 8%, and that to high beta stocks. So again, it is very, very risky, and one should be avoiding deep out of the money call options on the buying front. While on the selling front, it can be a very good idea to sell out of the money call options. 9 out of 12 times you stand to make a good profit. Then again, how many trading days should be there before which you can buy the call or the put option? I believe there should be at least 10 days, 10 trading days left for your option. What really happens is, as I've said, there has to be a 3 or 4 day cushion for you. If in the 3 or 4 days cushion, your stock price doesn't move in your direction, your call price comes down slightly, and if you've not closed out positions, you still have that cushion of 6 days. And in those 6 days, the stock can actually come up towards your price, or you can exit at cost or make a good profit. While if you only have 3 to 4 days to expiry and you're buying it there, there is a huge risk involved, because in options, whatever money you put in, you stand to lose everything. That is why always have a cushion of about 10 days and then take it from there. The VIX, as I have already told you, the VIX has to be low while buying and has to be really high while selling. This is the thumb rule for options. Now, lesser the total premium when you're buying, in strategy, as I've told you, if you buy a long straddle, that is buying the at the money call and the put strikes, what really happens is you've got to look at the premiums. What is the percentage you're paying premium for that particular call and put? Generally in index, which is very, very highly traded, like Nifty and Bank Nifty, that percentage is only 2%. That means when you're buying the call and the put option with 10 days to expiry, you've got to look at, for Nifty, you're not paying more than 200 points premium, or for Bank Nifty, you're not paying more than say 600 points of premium on a monthly expiry. If that happens, you stand to gain more, because index as a whole gives you at least 4 to 5% returns either direction, and you stand to gain. Again, in Nifty and Bank Nifty. But that if you're paying that premium, which is 5% of that index, that means that index has to move 5% higher from the current levels, and then you'll break even, and then another 3-4% for you to make a profit. that again becomes very risky in a particular month. So avoid doing those. Always calculate how much percentage profit, premium that you're paying for a particular strategy. It always really helps. Then for a weekly expiry also, this is one thing which can really help you. Weekly expiry, I believe, if you're paying for Bank Nifty or Nifty below 0.6% of the premium on a long straddle, that would mean you are paying less. There is more likely a chance of more than 1% rise from the current levels in intraday on the weekly expiry. Then there is a chance of more than 1.5%. On an average, there is 0.7% rise in the index on the weekly expiry. So if your premiums are less than 0.6%, you stand to gain during those periods as well. Thank you very much. I hope this video was helpful to you.